I learned this, my trading was changed forever. Liquidity secrets. Let's work. So characteristics of liquidity. We got cash heavy, magnetic, and launch point. So the reason that it's cash heavy is because in these areas of liquidity, these are deciding areas in the market, right? Very cash heavy areas in the market because we know banks and these large institutions are trading these markets. And then these areas are pivotal areas in the market. There are a lot of reversals or a lot of decisions to be made in these key areas. It tends to be cash heavy, acting as a resistance or a support. Not only that, they are very magnetic areas. So what do I mean? I mean that these areas of liquidity will more than likely be revisited again. If not now, they will soon to be revisited. And at that point, that cash heavy area, there will be a decision or something will happen to alert us how to take advantage of it and to just show traders how to spot it with their eye. I'll show you that after I identify them for you on the chart, just to help people identify them the way in which I do. Now, another characteristic of liquidity is that it tends to act as a launch point. So what do I mean as a launch point? Like when the market comes to these liquidity areas, the market can touch this liquidity and launch explosively to another direction. Very violent, very fast price action, very volatile price action. It can go bullish, it can go bearish. You can get swing trades from these market areas. You can get scalps or intraday trades from these market areas. But it's just very important and pivotal that we understand that liquidity areas are very important in the market, needless to say. So let me help you identify these areas in the market. So if you see my charts, you see that we got blue rectangles and we got black rectangles. Now these are called candlestick in the trading community. Now, the blue candles are bearish candles. The black candles are bullish candles. Bullish means up, bearish means down. But what I want you to understand is that these solid colored candles are the candlesticks, but the candlesticks also have what we call wicks in trading. So this thin line here, not the thin line between love and hate, but this thin line here, that is a wick, right? That's a wick. We go to here. This is a wick. This is a wick. Wick. These areas is wicks. This area is a wick. This area is a wick. This area is a wick. Wick. Just showing you wick areas in the market, right? Wicks. Wicks. Okay, let me just go back. Even this current area here is a wick, and I'll show you just a few more just so you can get the habit of it. By now, you should be kind of seeing what I'm showing. Wick. Oops, that's not what I meant to do. Sorry about that. Wick area. Wick area. Wick area, right? Wick area. These areas are wick area, wicks, wicks. Now, you should understand what wicks are. They're the very thin pieces of the candle, either to the bearish side, which is the bottom, or the bullish side, which is the top. What we have to understand is that wicks are areas where liquidity is present, right? So what I'm going to do is take this horizontal line here. I'm going to put it at the top of this liquidity and draw it all out like this. And I'm going to right click this because I already have my settings and put buy side 1 hour, right? So this is buy side liquidity. What does buy side liquidity mean? That means that the market comes to this area, it's buy side. Now this is key because in the area of buy side liquidity, if this area is cash heavy enough to hold, it will act as a resistance. This area of resistance will move price, as you can see, and reject price and send it bearish. If it does a few things that we needed to do, which we'll talk about later in this video. So make sure you watching the video and you can continue to watch the rest of the video. Like, comment, share, and subscribe if I'm adding value to you. This area of buy side liquidity acts as a resistance. If you don't understand resistance, it acts as a ceiling. So price should not go above this area when we're talking about liquidity. Now, on the flip side, we draw a horizontal line right here and bring it on out. So we got what we like to call sell side liquidity. So this is underneath. So when we have a wick to the low, it's likely to have sell side liquidity there. We have a wick to the high, buy side liquidity. So just like buy side liquidity, price comes here. It's a very possibility that this area could be reversed the market, right? And by reversing the market, it doesn't have to tap the area and automatically reverse. We're looking for a confluence of events to happen to let us know Now I should get in this trade for it to be a buy. Now I should get in a trade for it to be a sell. So don't think about it like a one size fits all. If it touches liquidity, it's going to automatically go here because this liquidity. We're not thinking like that. We're looking for a confluence event because we like to build a case as a trader, right? So let me delete this stuff off the screen. So now that I got that removed off the screen, I want to show you this little diagram here, right? So this diagram is structure. I always talk about structure, structure, structure. We like to combine these two things, right? So structure likes to go here. We make higher lows and higher highs. Now I got detailed video on structure, and I have another video on liquidity that has like a decent amount of views. The liquidity video, you should watch that video after this one or before this video. You can tie it in. It's going to bring you clarity to liquidity concept in the way in which I teach it, in the way in which I understand it, right? So we're looking at higher lows and higher highs. In the bullish market, we're going to get higher lows and higher highs. We expect this pattern to continue, right? We expect impulse, retracement, impulse, retracement, impulse retracement, right? So all that's saying is that in the bullish market, we're expecting the price to go up aggressively. And then after it goes up aggressively like this, the market will come back down against that aggressive move, which is called a retracement, before eventually continuing back and going aggressively higher again past that previous high. Now, this is the same thing on the bearish side, right? So we're looking for lower highs and lower lows on the bearish side. So on the bearish side, we're looking for the market to go bearish, impulse, retracement, impulse. So we like that to be a lower high. That's what we want to label this and call this. And this is a skeleton of it. If I'm moving fast, you can always rewatch the video. It's the 1 hour chart. So this is the movement we expect when we expecting a bearish move, right? So we're expecting a impulse, which is a strong move, retracement, which is going to move against the impulse, which is a strong move in a certain direction, retracement, impulse. That's the pattern of structure, right? That's the pattern of structure. So we got retracement, impulse, and it'll continue and continue. Next, what would you expect to see if we got an impulse? We're expecting a retracement. Now, do we know exactly when the market is going to retrace? We don't know that, but we know that eventually, if we had an impulse, we should be retracing to set up the impulse, right? Okay, it said my mic wasn't working properly. I will be pissed if this mic is not working properly, right? I will be pissed. So we got impulse retracement, impulse retracement. Now we're gonna move on forward. So it's very key for you to understand this, that the market, when you combine this concept with liquidity, you are able to find very pristine entries and very beautiful setups to get you whatever you're looking for, whether you are, well, for me personally, I'm a 2R trader. I'm trying to get 2% on my setup. So I risk 1% to gain 2%, or for example, whatever you're risking, you're going to double it. Now, these trades can be 2R trades. These trades can be 5 to 7R trades. It just all depends. So when we combine structure, so what happens next? We know impulse, retracement, impulse, right? So what we are looking for next is that what would happen if the market breaks this lower high? Well, in a bearish market, the market is going to make lower highs and lower lows. A rule that you should understand is that lower highs should not be broken if we're going bearish, right? So in this situation, this lower high was broken, which tells me, well, hey, if a lower high is not broken and we made a new high, that's a characteristic of a bullish trend, which goes up. So this structure could be reversing, right? That's what I'm thinking, that this structure will be reversing. So what I would see here is I would expect what? Retracement, impulse, right? Because now I'm expecting the market to reverse. Okay, now I'm expecting the market to reverse. So if you confused with that, I'm gonna show a couple examples. You can rewatch the video. I'll do more video. Just let me know. But let's continue. And this is the same thing, whether it's bearish or bullish. So let's delete this. Bow, bow, bow. Now, so how do we tie this in with liquidity? Well, let's just say we have a liquidity area here. You're going to draw this out. And this is buy side liquidity, right? This buy side area of liquidity on the 1 hour chart, let's just say we are at our trading time, New York session, pre-New York session, or the afternoon session, or the London session. Let's say we are there and the market begins to go bullish, make an impulse, retracement, impulse, retracement, impulse, retracement, then it does an impulse here. What should happen next? Well, if it's going to continue to go bullish, it should be impulse retracement. What do I mean by that? I mean that these higher lows that we putting into the market, let me do it here, and we're gonna do here. This should hold, right? This shouldn't be broken, and we should continue to get here and here, right? But now, what would happen if we have this happen? I'm gonna make this a different color just for the sake of making it pop out to your eye. Let's make it purple. That don't pop like I like. Let's make this area blue. So when the market comes here and there's a higher low, and then it's breached here, what do we expect to happen next? Just like I told you earlier, it applies both directions, where it's bearish or bullish. If a higher low is broken, higher lows are supporting price. We expect higher lows and higher highs to be made in the bullish market, lower highs and lower lows to be made in the bearish market. So when this higher low is broken, we expect the market to do what? Be transitioning to a bearish opportunity. So when this market retraces, this area of price that I'm highlighting is the opportunity to sell. This impulse that broke the higher low is the opportunity to sell. So inside of this area, you will look to take an entry. And this is EURUSD. So when I trade EURUSD, I'm only doing 8 pip stop losses. My goal is to get 16 pips, risking 1% in that 8%. In that 8 pip stop loss, and to gain 2% in that 16 pip take profit. So let's just say, for example, for people who get confused when we talk about numbers, let's just say my 8 pip stop loss represents $500, and my 16 pip take profit represents $1,000. So I would be risking 500 to make $1,000. Okay. So every 8 pips is calculated by 500. I'm risking 8 pips, that's $500. My take profit is 16 pips, that's $1,000 if I hit the take profit. Now, if I go to 24 pips, 8, 16, 24, that's 3 times what I risk. So that would be a take profit of $1,500. Now, I'm not about to keep doing it because I don't want to confuse anybody. And if you confused, wash your ears out right now and just understand. Look, you can rewatch the video. Damn. All right, bet. So let's go ahead. And I like to do those 16 pips. Now, this is not gonna show on this time frame because where I set it. But let's just say we go here to get 16. And you can see this say ratio 2, right? That means you're risking whatever you're risking, you're going to gain double. So risk reward, you are a 2R trader. I trade a 2R system. I often catch 3, 4, 5 Rs, but the basis of my system, my foundational system and setups are 2R trades. Now let's continue to apply this to live market action, or not live market because it's Sunday and the Lions about to get this dub. But and if you don't like the Lions, you know what I'm saying? I don't even think you should even know how to trade or learn how to trade from me. You feel me? But at the end of the day, what we're looking to do is capitalize on these liquidity opportunities because this is a cash heavy area. So I'm going to delete this and these drawings, and let's look at an example from January 12th. Hey, that's my birthday. Let's just go to January 12th. We're on this January 11th. This is the 12th. You can see the previous day, this liquidity here, what happened? Price comes to this liquidity, this sell side liquidity, right? So price comes to this liquidity area, reverses, goes bullish. And however many pips it went up from this area, it went up 50 pips, right? So for me, that's like a 5R trade almost. Well, that is a 5R trade. So let's just go here. Let's look at this liquidity area. We got a resistance area here. Well, a liquidity area here. We draw it out. Buy side off a 1-hour chart. Price went up above it, but then it eventually reversed to go down bearish. Okay, so this is a recurrent theme I want you all to understand and start to look at, so you can start to see, just drawing it on your chart, that liquidity will reverse price. Even here, price, it comes to this sell side liquidity area, and we can do this all day, and you will continuously see opportunities. Here, reverse price, market goes bullish, right? Why is it doing that? Because liquidity is where the money is at. Let's go here, January 3rd. We have an area here, and we move it on out. create that buy side liquidity, we see that the market reversed here. And not only is it reversing, it's going from this area here. This market went 60 to 86 pips within a day from this area here. And yeah, we did get some, a deep punch in there, but when it turned around and went up about 60 pips. Same thing here and same thing here. Now that's on January 11th. Now let's look at January 12th. So hopefully y'all understanding and seeing what I'm doing with these liquidity areas. And also notice that this is the low of the day, right? This is the high of the day, right? Liquidity at the high of the day, liquidity at the low of the day. Liquidity at this low of the day causes reversal. Liquidity at the high of this session causes reversal, right? So that's something I'll get into another more detailed video, but let's get to the examples. So today is Friday, January 12th. What we see, obviously, and we see wick high, wick high, wick high from the previous day. If we just look at the previous day, all we see is this, right? Now, we do not know if this area of liquidity is going to hold. Like, we're going to go here, split the difference. Boom. Buy side 1 hour. Now, we have no way to know if this is going to hold just off barely looking at it or just looking at it. But what we can do is look at our confirmations that we look for. That confluence of event I'm looking for, liquidity, we're going to talk about it right now. So now this is currently at 10 a.m. on January 12, 2024. So what I'm going to do, if I see liquidity on a 1 hour time frame, I'm going to drop down to a smaller time frame. And let's go to the 1 minute time frame. All right. And I'm going to just move this out the way. Boom, 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 boom. Okay, let's go to the 2 minute time frame. 3 minute time frame. So understand the structure and how the way in which structure works. What we can see is that we have a lower high here on a 3 minute chart. We have price making a strong bullish push here. Then the market impulse retraces. Then we got a internal impulse, retracement, impulse, retracement. Then they got an impulse, right? So that's all bullish structure that is showing me. I understand that this should continue. However, once price punches into this liquidity area and I start to see a wick after it made a high, so it has to make a high right here. So this was the last high that I'm pointing to, and it was broken right there. This then becomes the higher low. Now, this higher low on this 3 minute time frame, because this can happen on any of the time frames, the moment this is broken, which is right here, or maybe let me do a replay for y'all to see. The moment that this area is broken, I'm expecting price to do what? Just like the diagram I drew, retrace and then go bearish for my 2R. That's what I'm expecting. The market to retrace, go bearish for my 2R, EU21. That's what I'm expecting. That's it. Simple. Period. Point blank. So once this market is broken, I understand that this area here is a highly probable area. It's a priority zone that I like to call it. The area or a higher low that's broken or a lower high that's broken, a lot of times it's retested and then you can take a trade off of that. So I would bring this out. And if you look here, you see this lower high is broken. It's retested. It goes bullish, right? So I'm going to expect the same thing for my 2R. So let's watch price action. I'm going to zoom in. Boom, 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 boom. And we can just say we do looking off to hit off that zone, right? Price hit that zone. Continuing to watch. Wow. 2R. Just like that. Like that's over with. That trade is over with. This was a painless trading opportunity. And I'll show more examples, don't worry, but you can see it took about 54 minutes to capitalize on that opportunity. Now, is it 100%? No, nothing in trading is 100%. If you are a 50% win rate trader, 45%, 60%, you are doing great in trading. So understand that trading comes with a lot of losses. So we're going to say, you risk 500, the gain was 1,000. Excuse me. You risking the gain $1,000. You made $1,000 today. Now, look, for people who don't understand, who are overcomplicated and don't want to close out, think of your setups as checks. That's how I think of mine. Like every setup is a check. If I take, let's just say, 5 trades this week, that's 5 opportunities to get a check. That's how I look at it. So if I win 3 of my trades, I win $3,000. If I lose 2 of my trades, I lose $1,000 because 2 trades risking 500. 500 plus 500 is $1,000. 3 trades winning 1,000. 1,000 plus 1,000 plus 1,000 is what? 3,000. So 3,000 minus 1,000, I still be up 2,000 for the week. Okay, so let's deal with numbers like that, reasonable numbers. So that's how I look at trading. Let's look at another example real quick. I want you to look at this chart right here. And remember, we're going to be jumping from time frame, different time frame, just so you can understand. You have to get fluid moving through time frames because the market is one big fluid fractal piece of price action. Like just to say it like that. Not trying to confuse you, but you gotta learn the lingo. You gotta learn the lingo. So look here, we identified that this is a wick to the low. See what happened when the market hit sell side liquidity. Now we're not saying this happens all the time and it's gonna be there every single day, but when it's there, you need to look for the signs, right? So the market hits the sell side liquidity here, that wick, it reversed once, it reversed twice. Okay. The market, let's go back to the 15, dropping down. I like to look on the 1 hour, 15, and 4 hour most of the time. So you see market rejected, rejected, those are trades you can actually take. So let's go here, right? And just see what happened. So this high, the wick to the high, before price reverse, if you drag this out, 15-minute buy side, you see the price ran and punched up into here. Now you have to understand that once it runs and punches up to here, you're not going to be trying to take the trade off of this time frame necessarily all the time. You can, but you want to drop down smaller time frame. So we're gonna go ahead and drop down. What you can see is that we did have a what? Well, here's a higher low opportunity here. And not only did this higher low opportunity, what did the market do? Once again, the market was going bullish. For an extended period of time, the market was going bullish, making new highs and new lows, not taking out any of the higher low points, right? This is the last higher low point. Market retraces it. Excuse me. Didn't break this higher low point, but market retraced it. Finally made a new high. And immediately after it made this new high, there's the higher low. So when that happens in the market, you want to take this. This is a priority zone. You can have over the whole thing. Now, I look for a confluence of events even inside of here, right? And the confluence of events doesn't always mean the same thing. But even inside there, I'm looking for something in particular that I won't disclose right now. But, private one-on-one people have that access. And I'm only looking for a pip stop. So if you hit off the zone exactly, you still don't get taken out, depending on what industry you're in. Sell trade, you can see this market, once again, goes violently down to the target. Now, if you would have held this trade, you would have had a 68 pip move. Now, think about this. Think about this. If I'm risking $500, right, just for a hypothetical purpose, we risk 500. Um, to gain with that 2R setup, which is getting 16 pips, 2R, which means I'm just multiplying 500 by 2. What if I was to take that 500 and multiply it by 8.55? What would my profit be then? So I love math, but I'm not a calculator. So we're going to have 500 times 8.55 means I would have made $4,275. And why would I hold that trade though? Because I understand liquidity should and structure how to combine and blend them to maximize my gains. But you only need 2 R's. Now, if you get in this trade and then the trade just is in your favor heavy, it's no reason to close. No reason to close. Nothing down there telling you to close, right? Now let's just say for shits and giggles. Now let's go on the 1 minute chart. Look how smoothly I'm navigating through this. On the 1 minute chart, as you can see how that structure looked on the 1 minute chart, price wicked that area that was sell side liquidity, right? And what you see is that once it wicked at this structure level here, this lower high was violated. And once this is violated, the market does what? Impulse. When that violation is an impulse, retracement, and then an impulse again. So if you were even to get in this trade here, based off of just a little tap, and I'm only showing you taps, I'm not even showing you as accurate as I could actually get in, just opening your eyes to a concept. We're looking for 2R. There's your 2R right there. Now, let's just say when you take this trade, you can redefine or refine your stop loss because, hey, if this liquidity is already ran, then I'm just going to keep the market right below the liquidity. Let me just do 5 pips this time. This is the lowest point. It already made a new structure, so there's no reason for me to think it's going to go back down there, right? This move comes in at 11 a.m. Now that what used to be a 2R for your 3R, you can keep your 16 pip setup, but decreasing that stop loss is going to still, make it to where your RR is more. So now you're getting a 3R, right? And you will actually increase your position size. But I don't feel like doing the math on that right now. In recap and summary, I hope this liquidity video has helped you. Now, like, comment, share, and subscribe. I will be showing you more examples of trading. But as you can see, the market is very fluid in nature and that you can use liquidity trades to make some good profit. Hey, shit, I do. Like, comment, share, and subscribe. I am Legal Chunks. Follow me, LCF M Stacks on Instagram. Let's work.